Welcome back to Palisade Radio. I'm your host, Tom Bodrovics. Joining me today is a new guest to the show, Steve Penny. Most of you might know him as Silver Chartist on Twitter. How are you today, Steve?
Oh, I'm doing great, Tom. I've been looking forward to speaking with you for a little while now. I'm a first-time guest, but I'm a long-time listener and really enjoy your show.
Well, we're happy to have you, Steve. Steve is a technical analyst, and he has 15 years experience in the resource sector. Why don't you start by telling us a little bit about how you got into this space and what got you interested in it in the beginning, Steve?
Sure. Yeah, it was about 2006 or so that I picked up a book by Peter Schiff called Crash Proof. And the content in that book just opened my eyes. Like, how have I never heard these things before? You know, I was pretty savvy financially, but I had never heard about the Federal Reserve and the shenanigans that go on there. And it just opened my eyes to a whole new world of how the financial system actually works. And from there, I was hooked. I mean, I just consumed every book I could get my hands on, started trading and investing, and it became a passion for me, and it became really kind of a full-time job.
And as we were speaking before the call, Steve, why don't you share with us a couple of the books that really instructed your investing in the beginning and that really molded your mindset in this space?
Sure. And it's hard to condense it down to a short list, but I'll do my best. So I mentioned that book by Peter Schiff. I think it was called Crash Proof. That's the book that opened my eyes. I read another book that gives a great high-level overview of how this financial system works by Jerry Robinson called Bankruptcy of Our Nation. Just a fantastic book, especially if you're new to this world and how the Federal Reserve works and the petrodollar system. And then as I got into trading, I started reading a lot of trading books. Probably if I had to pick one, it's a textbook. But, you know, I was the type to pick up a textbook and just read it cover to cover and do it over and over again. It's called Technical Analysis of the Financial Markets, and it's by John Murphy. And if I had to pick one technical analysis book, it would be that one.
Excellent. So, Steve, going through your Twitter feed and doing some research for this interview, you speak about a generational wealth transfer that's coming. So tell us a little bit about how to participate in that and how you see that developing.
Absolutely. And when I say things like that on Twitter, I'm not really trying to be sensational. I'm just looking back at history. And this is just a historical cycle that's repeating. So when you talk about a wealth transfer, it's important to make the point that wealth is not destroyed. It's merely transferred. So, for example, in the 1930s, the United States experienced a deflationary Great Depression, where wealth was transferred from asset owners to those with currency or paper assets. So during that depression, the United States was still on a gold standard, so printing into oblivion just wasn't an option. Yes, the dollar was devalued against gold by 75% in 1933, but that was the extent of it. This time is different. As we enter what I'm calling the early stages of the Greater Depression, and others have used that term as well, there are zero constraints on currency creation and debt monetization. And this comes at a time when paper assets, namely bonds and other debt instruments and general equities, have never been so overvalued relative to commodities. So commodities, put another way, have never been so cheap relative to paper assets ever. So what we have right here, right now, is a recipe for phenomenal gains in hard assets, namely silver, gold, and uranium over the next 2 to 7 years. And that's what I've been referring to as a generational wealth transfer opportunity.
Perfect. And we were speaking a little bit about comparing that to the 30s as well and how you see, like you say, history has instructed you to kind of see that. So what are some of the parallels that we're seeing there?
Sure. It's kind of interesting. So preceding the Great Depression was the 1920s. They call it the Roaring 20s. You know, the stock market was just roaring. The economy was roaring. And of course, that was a bubble. Well, what have we had the last 10 years? Nothing but a big, massive bubble that's been fueled by excessive debt. So that's one huge parallel. And, you know, those excesses always have to be worked off. That's what led up to the Great Depression of the 30s and 40s. And it's what I see as leading up to the Greater Depression that we're heading into now.
So that actually leads me perfectly into my next question is, what are some of your key factors to understand about your macro thesis, Steve? We obviously know that the dollar and how much they're printing is going to affect and transfer into the commodities sector. But how do you see the macro factors leading into this?
Yeah, and I love that question because I am a short-term trader, but I think it's always important to start big to small. So to start with the macro thesis is important. And my macro thesis is really simple. The national debt is mathematically impossible to repay. And when you add in unfunded contingent liabilities like Social Security and Medicare, the situation just becomes absolutely untenable. It's just simple math. I still don't understand why this is even a debate amongst economists. So the situation we're in leaves politicians and central bankers with one of two options. Number one, they can default honestly and negotiate a complete restructuring, which would be absolutely devastating and it would result in civil unrest. So that's option number one. They're not going to pick that one. Option number two is they can print, which is just another form of default, but it's one that is not understood by the masses. And history suggests that politicians will always, 100% of the time, choose the latter. And silver and gold have a 5,000-year track record of being the primary beneficiaries of this kind of reckless fiscal and monetary policy. So what we're witnessing right now before our eyes is the repeating of normal historic cycles, but this time it's just on a much larger scale than has ever unfolded before, really in all of human history. And I don't say that to sound dramatic, but it's absolutely true in this case.
Absolutely. So how do we look at crafting a personal strategy to handle this type of transfer coming?
Sure. So everyone needs to have their own personal strategy. I'll preface by saying that. There's no one right strategy for everyone. And, my specialty is precious metals and uranium. So I'll just speak to how you might play the precious metals and uranium bull markets, because you can have other aspects of your portfolio that are part of your strategy. But I like to study and search for lessons from the 1971 to 1980 precious metals bull market and the 1999 to 2011 bull run. In both of those cases, there was obviously the potential for tremendous profits. But what's little known is that the vast majority of participants were either shaken off way too early or they held on way too long and watched their gains evaporate. That's why I stress so hard the importance of having a personalized long-term exit strategy that's based on measurable targets that meet your goals and objectives. So personally, I have three pillars that I look at for playing the precious metals bull market. Pillar number one is to own physical gold and silver stored outside of the banking system. The global financial system is extremely fragile right now, and fiat currencies are on a trajectory towards their intrinsic value, which is zero. And physical metal is an insurance policy against that. Pillar number two is to simply own a basket of high-quality mining stocks with a buy and hold strategy where you scale out according to, again, a personalized exit strategy. And then pillar number three is if you're inclined to trade, I encourage people to have a separate account that's dedicated to that purpose. Personally, I'm an active and aggressive short-term trader, but I only trade 10% of my mining stock portfolio. That way, if I were to screw it up, which I don't anticipate happening, it's only 10%. Because it's very hard to outperform a buy and hold strategy in a bull market.
Perfect. And before the call, we were talking a little bit about using physical as an insurance policy. But you were telling me a little bit about there will be a time coming when physical will not be available no matter the premium. So tell me a little bit about how you see that developing in this coming environment.
Yeah, absolutely. That's a great question. So in 2008, we saw massive physical shortages. Like if you wanted to get your hands on physical silver in 2008, there was probably a 2 to 3 or more month waiting time, and the premiums were huge. We've seen that several times in the last few years, including the last couple of months. There's been 3 or 4 month wait times. And it's my belief that we're in the very early innings of this bull market. For example, if you want to look to Venezuela, if you live in Venezuela right now and you're a retail investor, good luck exchanging your fiat currency, walking down to the coin shop and trying to walk out with some silver coins. It's just not going to happen. I think institutional investors and big players, they'll probably be able to get it at a price. But just the average retail investor, when the time comes, when you want it most, it's going to be the hardest to get. So the takeaway is to consider adding some physical silver and gold now.
So let's move on to talk a little bit about some of your most instructive trading tools. I noticed going through several of your charts, you use moving averages quite a bit. So tell us a little bit about how your trading tools instruct that.
I do, yeah. I'm glad you asked that. What I've found in my 10 plus years of trading is that simplicity outperforms complexity every single time. Complex systems that use a plethora of indicators and wave counts, et cetera, they can be really seductive. And I was caught up in that for a while. What I found over time is that simplicity outperforms. So here's just a couple of the tools in my toolbox, and there really aren't many. I like to keep my charts clean and simple. So of course I have price and volume. I use horizontal support and resistance, and it has to be obvious. It can't be some line that cuts through all kinds of price bars. It has to be obvious to anyone who looks at it for it to be valid. I also use the 50 and 200-day moving average, and I use these specific moving averages because they're the most used by retail traders and investors, but especially by institutions. There are many institutional trading algorithms that are kind of programmed in a buy the dip mode when price is trading above a rising 200-day moving average, and they're in a sell the rally mode when price is trading below a 200-day moving average. So I would say that the 200-day moving average is probably the most powerful indicator someone can put on a chart. And then I do use RSI, or the relative strength index, combined with some basic chart patterns. So that's pretty much my toolbox. It's not fancy, but it works.
Interesting, Steve. So kind of instructional to that, on August 9th, you tweeted a little bit about a coming pullback. So were you able to identify the pullback that we saw on that following Monday using those tools?
I was, and obviously nobody can predict the exact day of a pullback. And anyone who says they can probably isn't telling you the truth if they can do that. No one can do that consistently. Right. But going back to July 8th, silver had cleared the neckline of a reverse head shoulders pattern, which projected a measured move to the $26 level. And that became my short-term target. Well, we blasted through 26 and all the way up to $29.91 on August 8th, just as key $30 resistance was being approached in a technically overbought state. So one of my simple rules is that when price approaches a major resistance level with an RSI over 70, it typically, not always, but typically does not pierce that level on the first attempt. So I was kind of on the lookout for a pullback. And then a couple days after that post, we did get that $100 sell-off in gold and the $4 sell-off in silver. And what I'm looking for now is a consolidation between roughly $23.58 and $29.91 in silver, and roughly $19.23 and $2,089 in gold.
Perfect. Let's talk a little bit about the dollar. You have a long-term downtrend or a price target. So we have the US dollar chart up on the screen for those of us that are going to watch this on YouTube. So tell us what we're seeing on this chart.
Yeah, and I'm glad you asked about the dollar, because there's, especially lately, it seems like everyone's got very strong opinions on the dollar, and a lot of people in the precious metals community are actually bullish on the dollar. And I understand those arguments. They call it the milkshake theory proposed by Brent Johnson. And I've heard it, and I think he makes some pretty compelling points. And then, of course, there's some compelling points that oppose that. But for me, as a technical analyst, I look to price and volume as the arbiter of, who wins that debate. And right now, the dollar is selling off. And what we see, we just talked about the 50-day moving average and the 200-day moving average. Price is well below a downsloping 200-day moving average. So the dollar meets every definition of a downtrend. And right now, price and volume are telling us that the dollar is headed lower over the long term and not higher. That doesn't mean it's not due for a bounce, but the trend is clearly down.
Perfect. So which indicators would have to change for us to see that reverse, just hypothetically?
Yeah, sure. So the first thing I would look for a bullish dollar reversal would be a cross above the 200-day moving average. And then if that 200-day moving average starts to slope up, that would kind of meet the definition of an uptrend. And then I would be more open to dollar strength in the intermediate term.
Excellent. So it would just be the exact reverse of what we're seeing on this chart, right?
Exactly.
Perfect. Do you ever take the fundamentals and, let's say, what you're hearing in the news into consideration of your interpretation of a chart, or is it just strictly the data that you see?
I'm so glad you asked that question, because it's very misunderstood when I post. So I invest for the long term, and when I'm investing, I want the fundamentals to be a wind at my back. Obviously, I want my fundamental thesis to be bullish. So when I'm investing for the long term, yes, I watch the fundamentals very closely. But when I'm trading, I'm solely looking at the charts. And trading can mean a lot of things to a lot of different people. For me personally, when I trade, I'm looking for roughly a 5 to 30% profit in 5 to 30 days. So it's kind of short term. So in those short term timeframes, I'm solely looking at the charts.
Perfect. I think that keeps things nice and simple, right?
Yeah, they say price and volume precedes the news. So usually the charts will tell me what's happening before the news. You may not know what the news is going to be, but for example, if the dollar breaks down, you'll see a headline, usually a couple days later. Oh yeah, that's why it sold off. So the fundamentals will explain the technicals in short order afterwards, is typically how it goes.
Perfect. So let's move on to gold. Before the call, we were talking about some long-term price targets and just using history to instruct what we could see out of this bull market.
Yeah, that's a great question. And we were talking before the show, and we were both talking how we're not trying to sound sensational here, and I'm certainly not. But the numbers I'm about to lay out here, it's just historical precedent. So I'm certainly not trying to make some kind of sensational claims. But if I could, I'll just kind of walk through some logic on how you can get to $15,000 gold by 2026 and how that might imply a $750 silver price. So in 1971 to 1980, gold rose roughly 22-fold. And that was an 8-year bull run, roughly 8 years. And then if you look at 1999 to 2011, gold rose roughly 800% in 12 years. So if you take the average of those two and apply that to the current bull market, you can come up with some reasonable targets. So from 1971 to 1980 and 1999 to 2011, if you just average those, you come up with a 15x increase on the gold price, or 1,500%, and the average length of that bull market was 10 years. So if we use 2016 as a baseline, that's where gold bottomed in January of 2016. It bottomed at $1,050. So if you apply those numbers to the 1050 gold price, you come up with $15,000 gold. And a 10-year bull market would get you there in January of 2026. And that case has been made by Jim Rickards, and I think it makes a lot of sense. Now, a lot of people talk about the gold and silver ratio, or the gold to silver ratio. And historically, bull markets peak at a 16 to 1 gold to silver ratio. That's what it peaked at in 1933, or it was pegged there, I should say. And in 1980, the gold silver ratio reached 16 to 1. But in this case, let's be conservative and just say 50 to 1. So 50 to 1 gold silver ratio at $15,000 gold gives you $750 silver. Now, I realize that might sound sensational, like I said, but that's just historical precedent. And I also want to imply here that just because those might be reasonable targets, that doesn't mean I'm going to hold all my silver and gold and mining stocks until those targets are reached. That's where you need to have that long-term exit strategy to sell into strength along the way, or at least that's what I would advise considering.
Yeah, it seems to be a pretty simple extrapolation of historical data to be able to reach those targets. Why don't we talk a little bit about something you just touched on, was your exit strategy. So you have something called your ratio-based exit strategy. Can you tell us a little bit about what you take into consideration when you're talking about that?
Yeah, absolutely. I've got a detailed exit strategy, and I recommend everyone craft their own, as I've said a couple times already. But mine is based on ratios, and I plan to sell most of my mining stock holdings into strength according to predetermined ratios. So a couple things I look at. In 1980, the Dow gold ratio reached 1 to 1. Gold peaked at roughly 850. The Dow bottomed at 850, 1 to 1 ratio. Roughly the same thing in 1933 when gold was revalued up to $35 an ounce. It's about what the Dow bottomed at. So it's reasonable to expect we'll see a Dow gold ratio of 1 to 1 again. Again, that doesn't mean I'm going to hold all of my mining stocks until that ratio is reached, but I can start scaling out as we approach that ratio. And there's a lot of ratios, but another one I look at is silver to real estate and gold to real estate. So like in 1980, you could trade roughly 1,000 ounces of silver for a median home price, the median priced home in the United States. So that's another ratio I look at, and you can do something similar with gold. So hopefully that answered your question.
Yeah, absolutely. And I love the simplicity that you look at this stuff through just basing it on historical ratios and really using that to instruct possible exit points for yourself. Let's move on a little bit to SIL.J. I know you were saying that it's one of the most undervalued components of the precious metals complex. So tell us a little bit about why you think that.
It is, yeah. Personally, I kind of look at the precious metals complex as a sector, precious metals sector. And then in my mind, I break it down into 6 subcomponents. So you would have physical silver, physical gold, senior gold miners, senior silver miners, junior silver miners, and junior gold miners. And what I like to do on a weekly basis is run ratio analysis of all of the different components to see what's most undervalued. And at the start of this bull run a few months ago, SIL.J, or junior silver miners, SIL.J, by the way, is the ETF for junior silver mining stocks. That was ridiculously undervalued relative to the rest of the precious metals components. So I've been heavily overweight junior silver miners, and as the bull market progresses, I can rotate amongst different components while maintaining full exposure to the precious metals sector.
Excellent. So let's move on completely from the precious metals and talk about one of your other areas of focus, Steve, the uranium miners. You're saying that they're coiled and ready for a move. What do we need to see from them to see them start to really heat up?
Yeah, that's a great question. So as far as timing, I look to the charts. But just like we did for precious metals, I like to start big to small. So the macro fundamental case for uranium is just off the charts bullish. It's just a matter of time. So I'm going to look to the charts for timing. But a high-level overview of the fundamental bull case for uranium is that nuclear accounts for a significant and growing portion of clean baseload power. And I say growing because uranium is a growth industry. Roughly 20% of the baseload power in the United States is nuclear. Yet the all-in sustaining cost to mine uranium from the ground is well above the current spot price, just as a supply crunch is looming. And I think it was Rick Rule who said a long time ago that really stuck with me, Anytime the price of an essential commodity is trading below the price to mine it, one of two things must happen. Either the world finds a replacement for that commodity, or the price has to rise. And in the case of uranium, the price is going to have to rise in order for supply to meet demand. There's no replacement for uranium. So it's just a matter of timing. So long term, I view the uranium sector as a 2 to 5 year play. And just as we're talking, many of the uranium mining stocks that I track are consolidating above that 200-day moving average, which is just starting to slope up. And that technically signifies the likely beginning of a long-term uptrend in the uranium sector.
Excellent. And do you have any major price targets for the uranium spot price? Obviously, market conditions are a lot different in this day and age than they were for the last bull market. But what do you think we could see out of the long-term uranium spot price?
I don't have any long-term price targets, but I can say the uranium spot price right now is, I haven't checked today, but it's roughly $33 a pound, somewhere around there. And in 2011, I believe, or maybe it's 2008, it peaked up around 130 or 140, somewhere in that ballpark. I could be slightly off. But the point I'm trying to make is it's got a long way to run. And if the uranium spot price does even half of what it did in the previous bull run, some of these mining stocks are going to go absolutely berserk.
Absolutely. And I believe I read something today that's just more wind at the back of the uranium miners to set up this thesis about them being coiled to really spring, was that Kazatomprom is announcing another 20% cut to their production numbers for next year for 2021. So nothing but, like I say, wind at their back, right?
Absolutely, yeah. Even pre-COVID, the uranium sector was headed for a supply crunch. And then after COVID, Kazatomprom shut down their wellhead development. And I don't want to get too technical in here because I don't want to talk above my own head. But basically, that was a big additional constraint to supply. And if you're not familiar, Kazatomprom is like the equivalent of Saudi Aramco. They're the world's largest uranium producer. Just, I don't want to say shut down, but drastically slowed down their production. And at the same time, you have Cameco, which is the second largest producer, put their two largest mines. MacArthur River had been on care and maintenance, and then Cigar Lake went on. I'm not sure if the care and maintenance is the proper term. There's a lot of technical people in the uranium market, but Cigar Lake was effectively shut down, may not be the right word, but the supply was greatly curtailed out of Cigar Lake. The bottom line is you've got the two largest producers effectively greatly diminishing their supply to the market at a time when demand is growing and supply is diminished.
Perfect, Steve. One of the other things we were talking about before the call that I really enjoyed, again, the simplicity of the way you're looking at it, is the platinum to gold ratio. And it's not necessarily that you're an expert in the platinum space, as you were telling me, but it's an instructive ratio to look at. So tell us a little bit about how you see that.
It sure is, yeah. Whenever a historic anomaly like this comes across my screen, it's worth paying attention to. But at the same time, I'm trying to exercise discipline. My plan is to stay laser focused on silver, gold, and uranium, as I personally believe that's where the most upside potential lies. But that said, the platinum price right now is trading at an all-time low valuation relative to gold and other commodities. So the platinum to gold ratio right now is near an all-time low. Someone told me it may have been a little bit lower, but that was like 100 years ago. So regardless, the platinum price is very undervalued relative to gold. And when things get out of whack, they typically revert to the mean and then overshoot to the upside or to the opposite side. So it's something worth watching.
Perfect, Steve. Well, as we wrap up, do you have anything else you'd like to add?
No, not really. I'm really grateful that you had me on. It's been a pleasure speaking with you and getting to share some thoughts with your audience. And if anyone would like to learn more, I'm on Twitter at SilverChartist. And it's been a great time talking with you, Tom.
Well, we appreciate your time. You have a newsletter that you're getting set up to be released soon, right?
I am, yeah. I'm glad you asked. Basically, I really enjoy sharing my thoughts on Twitter. I've been in this market for, like I said, almost 15 years, and I've spent the vast majority of that time talking about this stuff to people who don't necessarily want to hear it. And then I found Twitter, and I'm like, wow, this is a great outlet to share my thoughts. But Twitter, limits your characters, and there's some limitations on that. So, I decided to get ready to publish a free e-letter. So that's coming soon. You can follow my Twitter feed at SilverChartist, and you'll see a link to sign up for that free e-letter coming soon.
Perfect, Steve. Thanks for your time today.
Yeah, thank you so much, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?